Okay, so now we're going to walk through an example of a deferred tax liability. It's a fairly common example. I will say right away, this video is going to be a little bit longer because it does take some time to walk through the example. And so I apologize for that in advance, but hopefully you can hang in there. Okay, so first of all, this is the definition according to US GAAP of a deferred tax liability. It represents the increase in taxes payable in future years as a result of taxable temporary differences existing at the end of the current year. It's kind of a mouthful, but if we take it apart, hopefully it can start to make some sense. Okay, I highlighted the two pieces of this definition that I think are most important. First of all, we're talking about taxes payable in future years, and also that this difference is a temporary taxable difference. And so the idea is with the deferred tax liability, there's some underlying net asset. When I say net asset, what I mean is assets minus liabilities. And there's a specific item where it is temporarily, the net asset is temporarily greater under US GAAP. This can come from one of two places. One, revenue under US GAAP. There must be revenue that's recorded under US GAAP that's going to be recorded later under the Internal Revenue Code. Or potentially there may be an expense under the Internal Revenue Code that will be recorded later under US GAAP. As an example of the first one, let's say that you have a receivable that would be recorded under US GAAP. That net asset then increases, but the receivable, let's say, isn't recorded as income under the Internal Revenue Code until it's actually collected. So there's this temporary difference. As an example of the expense, prepaid expenses are kind of a common one, where there may be a prepaid expense on rent. Of course, the net asset is created under US GAAP, but it's expensed immediately under the Internal Revenue Code. And so we have an expense under the Internal Revenue Code this year that will not be recorded as an expense until later under US GAAP. If there's a situation where that net asset exists over multiple years, then you really have to think about the cumulative effect, and that's where the balance sheet really comes to play. And that's one thing we're going to do in our example. There's going to be multiple years that we have to think about. Okay, so we have this example where 49er Company acquires $15,000 in equity securities on July 15th, 2020. And then we have some different fair values over the 2020 and 2021, and then we have a sale in 2022. In this example, I also give you 3 years of pre-tax financial income, which is US GAAP financial income, and also the firm's tax rate. We're going to assume that the Internal Revenue Code does not record unrealized gains and losses, which means they're not going to record anything related to this asset until it's sold. And of course, under US GAAP, we do record unrealized gains and losses, and so there's going to be a temporary difference between the two systems. So there are 3 important elements whenever you're approaching any journal entry. The first one is you do have to calculate taxes payable, and you do that by reconciling pre-tax financial income to taxable income. The second thing you have to do is calculate any change to a deferred tax liability, again, because this is a deferred tax liability problem. That's our focus. And the way we're going to do that is we have to identify and calculate the tax effects from any temporary difference for this specific item. Again, this is with the specific item of the equity security. And then finally, you derive your income tax expense. And essentially, that's a plug in your journal entry for this simple example that might seem like overkill, but for more complex examples, it's actually very helpful. Okay, so for 2020, we're going to focus on the fair value information in 2020 and also the pre-tax financial income from 2020. And so we start with pre-tax financial income of $560,000. Then we have to realize that under US GAAP, there would have been an unrealized holding gain or loss that would have been part of financial income. We do not record that unrealized holding gain or loss under the Internal Revenue Code. Therefore, we have to subtract it from our pre-tax financial income. Then we have our Internal Revenue Code taxable income. We apply the tax rate, and we have our income taxes payable of $195,650 for 2020. Now to go turn our attention to the deferred tax liability, again, we're going to use the balance sheet approach in order to kind of get clarity on this problem. It's a very simple one, but I think it's applicable to more difficult problems, and you're going to see some things that are important as we go through this example. But to do the deferred tax liability calculation from the balance sheet approach, you look at the book value of the equity security under US GAAP, and it would be $16,000 because you'd have the original cost plus the fair value adjustment of $1,000. The book value of the same equity security under the Internal Revenue Code would still be at the original cost of $15,000. Therefore, there is a difference in book value equal to $1,000. This is the income effect of the difference of this temporary difference. We apply the tax rate, and then we have our balance in the deferred tax liability. We compare that to the previous balance, and we can see that the change in the deferred tax liability is the entry amount, and in this case it's an increase to our deferred tax liability of $350, and that would be a credit entry. That is the income tax effect as well. Okay, so now going to our journal entry for 2020. We start with our income taxes payable, $195,650. And then we have our deferred tax liability of $350. And from that we derive our income tax expense of $196,000. Okay, so now we're going to turn our attention to sort of a conceptual framework of thinking about how these two things, how all this fits together. And so I start by sort of taking US GAAP on the left-hand side and comparing it to the Internal Revenue Code on the right-hand side. And so we start with the book value of a net asset, which in this case, the equity security has a balance of $16,000 under US GAAP. The same equity security has a balance of $15,000 under the Internal Revenue Code. And so in both cases, there is this difference. And so we have to think about what is the effect of our accounting of the security on our accumulated income. And of course, we know under US GAAP, there is an unrealized holding gain or loss of $1,000. Of course, there's been nothing done under the Internal Revenue Code, so there's no income effect under the Internal Revenue Code. And so from there, then we can kind of take the tax rate, and then we get our accumulated income tax effect. And we can see that the accumulated income tax effect from the treatment of the security is $350 under US GAAP. And of course, it's zero under the Internal Revenue Code. Again, just some extra information here on how to think about the income tax expense from 2020. The total income tax expense was $196,000, and that has two components: the current tax expense, which is the current year's taxes paid, and also the deferred tax expense, which is the portion that will be paid under the Internal Revenue Code in the future. So these two terms, current tax expense and deferred tax expense, are important terms to understand in this chapter. So now we're turning our attention to 2021. And we start with our pre-tax financial income of $610,000. Now in this case, there is an unrealized holding gain or loss dash income, but in this case, that account would have been a loss under the under US GAAP. And the reason that it would have been a loss is because the fair value actually went down $400. And so there would have been an unrealized holding loss in 2021 under US GAAP. And so we have to add that back. That gets us to our Internal Revenue Code taxable income. We apply the tax rate, and we have our Internal Revenue Code taxes payable. Same idea with the deferred tax liability. We have a new book value under US GAAP of $15,600. We compare that to the Internal Revenue Code, which is still at the original cost of $15,000. And we see the difference in book value is now $600. Now, because this is multiple years, this is now the cumulative income effect for the treatment of the equity security. We multiply it by the tax rate, and we get a deferred tax liability balance of $210. That $210 is the cumulative income tax effect from this treatment of the equity security. We compare it to our previous balance, and that last line then gives us the change in the deferred tax liability, and that is the entry amount that we'll use in the journal entry. And that is the current income tax effect from our treatment of the equity security. So now going to our journal entry, We start with our income taxes payable, which we calculated as $213,640, and the entry to the deferred tax liability of $140, and we can derive our income tax expense of $213,500. Again, plugging all this information into the framework that we've been using here, we can see that the balance in the equity security under US GAAP is different than what's been reported on the Internal Revenue Code. There is an accumulated income effect. Remember, there was a gain of $1,000 in 2020, and then there was a loss of $400 in 2021. So the accumulated income effect under US GAAP is $600. There is no income effect under the Internal Revenue Code, and so then the accumulated income tax effect is that $600 multiplied by the tax rate of 35%, which means we have a $210 income tax effect under US GAAP, and of course still no income tax effect under the Internal Revenue Code. All right, now for the final year, there was a sale in 2022, and so we've got to handle that under both systems. So our pre-tax financial income under US GAAP is $635,000. There's a gain on sale under US GAAP. Of course, that gain on sale is not the same gain that's going to be reported under the Internal Revenue Code, and so we have to back that gain off. And so the net carrying value of the security under US GAAP was $15,600. We sold it for $16,100, and so we have to subtract the $500 gain out. But there is a gain that is recorded under the Internal Revenue Code, but in this case, the asset was still at the original cost of $15,000. And so when they sold it for $16,100, the Internal Revenue Code would have a gain of $1,100. So the taxable income is $635,600. We apply the tax rate. So once we apply the tax rate, we can see that our income taxes payable is $222,460. Sort of the same step as we've been doing before, but now of course the equity security has been sold, and so on December 31st there is no balance in the GAAP equity security account. There's also no balance under the Internal Revenue Code, which means there's no difference in book value. So it must be the case then, if there's no difference in book value, that there is no cumulative income effect. If there's no cumulative income effect, there's no cumulative income tax effect. However, there was a previous balance of $210, which means there was a change to our deferred tax liability in 2022. It was a decrease of $210, and this would be the current year income tax effect from our treatment of the equity security. So turning to our journal entry, we can see our income taxes payable, the change to the deferred tax liability, and from that we derive our income tax expense of $222,250. We'll complete the picture by looking at the conceptual framework. Of course, there's no balance for the equity security under either system. There is a cumulative income effect under both systems. Under US GAAP, there was a gain on sale of $500, and there was a cumulative unrealized holding gain of $600 for a total of $1,100. Under the Internal Revenue Code, the entire $1,100 would have been recorded as a gain on sale. But you can see under both systems, the accumulated income effect is the same, $1,100, which means that the accumulated income tax effect would be 35% of that under both systems, and so it's in both cases $385.